If you want to start, you can start.
Okay, very good. Good morning, everyone. Let's do a roll call.
Jerry Abrahams,
Present.
Alexandra Dom, Phil DeFranzo,
Here.
Timothy Hodges,
Present.
Catherine McKinnon, Commissioner Perez, Franklin Perry, Sarah Sanders.
Here.
You have 4 folks present.
Okay, so we have one action item and some reports. We'll go into the first item. Hazim.
Thank you. Good morning. As mentioned, finance, we do have one action item for your consideration. The first one is a resolution to authorize CHFA to issue up to 100 million of its housing mortgage finance program bonds. The sale will allow CHFA to raise additional 100 million of lending proceeds for first-time homebuyer program and to preserve prepayments. For the first quarter of 2022, CHFA has purchased about 79 million. CHFA will utilize fixed rate and floating rate structures and overlay with a swap and expect that to close around July. Bank of America is assigned as the book running manager for the bonds, and I'll be happy to answer any questions regarding the resolution.
So Hazim, you said you've already purchased 79 million of loans and you're using your warehousing lines for that?
Yeah. So the way that we are doing it is we are laddering in terms of how we manage our pipeline. So we would utilize our warehouse line and would issue bonds as we get to a particular critical point. And then upon issuance, we would then reimburse the warehouse line and we'll do it all over again.
And you're using variable rate with a swap because you think you get better all-in rate? Is that, you feel you need to do that in this market?
Yeah, so one of the things that if you remember for finance committee, we did discuss at the 2020 meeting when we, along with the advisor at the time, to discuss the capital studies, and within the capital study, we discussed about the need to use variable rate debt to lower our cost of capital and the risks associated with it. So our intention has been to scale back the use of variable rate debt whenever possible. But based on the current market condition, especially in the long end, we believe that utilizing a variable or floating rate structure is more optimal. But then at the same time, we're not issuing as much variable rate debt in the past. So in this particular structure, we are setting aside about 20% of the lendable proceeds issuance with variable.
And this is a new swap that will be bid, or is this the reconfiguration I think you're doing of some other swaps?
No, this will be new. This will be new.
Hazim, what form does the variable rate take? It's been a while since I've looked at. Is it if they sell, you sell index floater, or do you sell like do they still sell just standard VRDOs with
VRDO.
bank liquidity?
Yeah.
And you get bank liquidity?
Yeah. We already have procured bank liquidity. It's with JP Morgan.
So you get bank liquidity with JP Morgan, and then when it's the swap, I assume, do you hire a swap broker like Lamont or somebody to bid out the swap?
Yeah. That's our standard operating procedure.
And you only bid it out with people you have the masters with?
That's of course that's the critical, but one of the things for any provider to bid for a swap, they do need to qualify the general resolution requirements. So there is a minimum rating requirement.
Yeah.
So
Does
Will
it
the
pack
swap
the
be
matter? Exactly
LIBOR?
what is
Oh.
this? Sorry, Sarah, go ahead.
No, you go, Jerry.
I just wanted, so, but just to confirm, it's generally only people who you've got previously executed ISDAs with, right?
Yeah, generally that will be the case. But then at the same time, it's not to say that we will not consider. It's just that we have to go through the whole process of negotiating
Oh,
the
no, I understand.
ISDA.
Right.
We won't bid a swap until we have an ISDA that's signable.
Right.
Okay, thank you.
Will it be a LIBOR swap or a SIFMA index swap?
SIFMA.
Any other questions on this item? May I have a motion?
I'll move, Sherry.
Second,
Ken, second.
roll call vote.
Jerry Abrahams.
Aye.
Alexander Dom. Phil DeFronto.
Yes.
Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
Commissioner Perez. Franklin Perry.
Aye.
Sarah Sanders.
Aye.
Vote passes unanimously.
Okay, our next item is report on the last bond sale 22 Series B with Morgan Stanley.
Hey, thank you. So here with us this morning is Jeff Brew, and I believe Alex Blamis is also on the call here. But Jeff will be walking the committee through the transaction that we did last April. So this is a multifamily execution, as noted in the memo, and it's pretty well known that interest rate has been rising since earlier of this year. And but then we made it through. So Jeff, why don't you take it over?
Morning, everybody. It's great to see everyone. And Hazim had a nice lead in with "we made it through," and we did make it through. I think we made it through really well. Part of it was about setting up for what is a very challenging market to navigate through on any given week. And as the Fed started to raise rates this year and to talk about that, and with the increased inflation, any pricing in and around economic indicators that are coming out or Fed meetings has taken on a very different kind of complexion. And we look to the calendar now we've always looked at it with those in mind, but now it's even more important. And it's also important to focus on supply in the marketplace around weeks prior to Fed meetings, because what is tending to happen now is we get a concentration of issuance in weeks leading up to Fed meetings. People are trying to get their deals executed ahead of that key information that's coming out in the marketplace, which has caused the markets to move substantially. And then the follow through in the markets then incorporating whatever the Fed does at a meeting takes a little bit longer than it has historically. A year ago, we would have been able to price a deal quite well during a Fed meeting or the week after. Now the markets have become much more volatile in and around those dates. So knowing that and looking at the calendar that we were contemplating going into the sale, we talked with Hazim and Bob about those facts, and thinking about the schedule, we had originally looked to get into the market the week of April 25th. Knowing that the Fed meeting was the week following and that we saw a growing calendar, which we presented to Bob and Hazim, we put our heads together and saw that, and we brought this up well in advance of the sale. So we had enough time to adjust how we were getting it to the market. We got the POS out so that we were able to effectively market the bonds and get into the market with a smaller amount of supply the week of the 18th. It worked out very favorably, and that's really the result of looking at the calendar, which the week prior to the Fed meeting, the week of the 25th, had been building to 12 plus billion.
Hey, Jeff,
Yes.
I apologize. Lorraine, can you move the
Yes.
slides?
Sure.
Yeah,
Tom,
let's put slide 4 up. That's great.
Yeah.
Perfect. Thanks, Azim. So this really is the summary of the overall transaction, and it highlights what I just ran through on the accelerated pricing schedule. The team did an excellent job getting the book released so that we could market the bonds and do it in a week that was less crowded and away from that Fed meeting. We also looked at the structure itself, and we made a couple of changes that were based upon what we were seeing in the marketplace, able to differentiate and get in with 5% premium serial bonds. This is something that CHFA has done in the past, but this was the first time it was done on a multifamily deal. Worked out very, very well because it accessed a different part of the market, effectively segmenting the marketplace and going to where there's more demand. And as you can see on the summary sheet here, of the 8.3 million of serial bonds, we were able to improve pricing by 5 to 25 basis points relative to par serial bonds. So it worked out very, very well. The other thing that was a little bit different here is that we had received reverse inquiry from a large insurance company that is periodically in the market. They're not always in the muni market, and they're not always in the market for housing bonds. However, we have seen them periodically come in, and when they do, they tend to buy large block sizes. They also have a specific need for a 10-year optional call. In our housing transactions, the optional calls have gravitated to a shorter period, and typically CHFAs have been in 9 to 9.5 years. We put this in front of Hazim and Bob, saying that this insurance company had come back to us and made the ask. We also vetted it prior to going into the marketplace and felt very confident that they were going to come in with orders. They in fact did place orders for 37.9 million. So this strategy of lengthening out that optional call to bring in that order was really important. Those orders were in the term bonds, so in the most expensive part of the curve, and very helpful to getting oversubscriptions and getting pricing benefits. Overall, on the retail side, we were talking about this before everybody got on with Sarah, just about the state sale and the excellent results from retail. The results for your transaction here were also very, very strong and supported by many of the syndicate members, including some of the selling group. The total amount of retail was about 40 million, 39.1 to be exact. And that was broken out by direct Connecticut retail of 24 and national retail of 14. So overall, very strong result there too. One other key point on the overall institutional orders is that a change that we made for the authority, including the sustainability bonds designation, included the specifics about the projects that are being funded. The specifics meaning the area median income associated with the projects that are being constructed here is something that was never incorporated into the disclosure prior to the sustainability bonds designation. Super helpful because it brings in those orders that are CRA focused. So we had 40 million of CRA orders in this transaction from 2 different CRA buyers, and very, very pleased to see that. That was very helpful also with oversubscriptions on the back end. All of this order flow allowed for pricing benefits to the authority, and this was in the context of a difficult market with MMD increasing while we were pricing the bonds, and we were able to execute at very favorable levels, even though there were headwinds. Also, an important point here to know is how we stacked up versus comparables, and we did very well. So the comparables in the marketplace were West Virginia, New York City HDC, and Virginia housing. All of those were more expensive or higher in yield than CHFA. So all around, the transaction worked out really well. The story for the rest of the year, because this pricing was 5 weeks ago, but in fact, it feels like it was a long time ago in this market. We've seen a fair amount of housing issuance because housing issuers are accelerating deals to get into the marketplace earlier, and then negotiating around the turbulent market. An example of that is last week we priced a deal for Florida housing. In a matter of hours, the market shifted, so a comparable issue ended up pricing substantially higher in yield than the Florida deal, and that was, like I said, just a matter of hours. So I know Hazim and Bob will be very focused on that going forward, because timing here is definitely very important in this market. And with that, I will open it up for any questions.
I guess I have a question for Hazim, for you, right? So when you do the premium bonds, so the investors like it because it shortens the duration, right? But how does that affect? Is there any effect for us in terms of our cash flow and how you essentially do your asset liability match? Was there any downside for us by providing premium bonds to get the lower yield from the market?
Well, the simple answer, the downside is you just lose option, right? You lose that flexibility.
Well, they're serial bonds though, so you don't really
Yeah.
care that much,
I
right?
think the echo is coming from Lisa Hensley based on the lighting up of the cube, if she could mute.
Sorry.
I don't know, that's what I think. If you could.
Thanks,
mute.
Sarah, because I hate hearing the sound of my own voice like
Okay.
most people.
Yeah, so what we lose will be the option. So that essentially will be the biggest downside. I think in terms of how we pursue premium lockout bonds is to ensure that we manage the matching as best as we can. So in this particular situation is for multifamily. So when it comes to multifamily, we know that there is that lockout in place on the loan itself. So it's something that we felt that we were comfortable with. Yeah.
Any other questions? I just wanted to make a comment at how well planned I thought the board retreat was, and I really thought it was so worthwhile. I was kind of on the fence, do I go or not go? And it was so worthwhile, and I've really been talking it up since then. But one of the topics that we touched on slightly that might be a topic for a future finance committee meeting is the impact on higher interest rates on the HFA financing. Now, I know we keep saying that the competitive advantage is better for HFAs in higher interest rates for taxes, because the tax exempt bond advantage is greater. But obviously higher interest rates are going to have an effect on demand. So it's really just a relative competitive thing that it's better on. But I think a few questions have come up on that in the past. It might be a good topic, either for this committee or the full board, because we are in a way higher interest rate environment. What are the different effects? You know, maybe it helps our competitive advantage, but it probably hurts all banks with mortgages because of the higher interest rates. So that's just a thought I had coming out of the board retreat, which was so good.
Yeah, so Sarah, I think like yeah, we definitely can come up with something for future discussion. I think from my perspective, it's all about trying to spot a dislocation in the marketplace, because you're trying to find that sweet spot. So right now, what's happening is while interest rate is rising, and we believe, at least just based on what you said, right, in a high rate environment, one would think that tax exempt execution will provide better value. But you have to also look at the ratios between tax exempt and taxable. So right now there is that disconnect. So we are not really seeing or getting the historical benefit of tax exempt at the moment. But then at the same time, at least when it comes to our reinvestment income, we are seeing a rise in that. So when we try to balance between the two, now we're talking about where the yield curve is at. So then it goes back to that dislocation. How do we price, or how do we present and showcase our brand to ensure that we have that interest from our stakeholders?
Certainly higher interest rates hurt our first time home buyers.
Right.
And so that's the other factor that's not so technical, but more global. So
Right.
it's hard to balance the whole thing, but it might be a
And that's
topic.
why we have our down payment. So
Right.
that's right. So I think that depending to the product, whether it's single family or multifamily, we are looking into ways where we realize what's happening on the ground, whether interest expense is higher, the supply chain issues is causing higher, construction costs. First-time home buyers, you have rising home prices. We're trying to figure out ways where we can provide that, greatest impact.
But we're in such a new market, it just might be worth a discussion of all the
Oh, absolutely,
impacts. Yeah,
absolutely,
and there's some positives, interest income, as you brought up. So,
yeah.
okay, now to Allison Murphy.
Good morning. Before you are the April financial reports. On the revenue side, mortgage loan and investment interest and revenue are coming in $3 million below budget for the first 4 months of the year and $4.6 million lower than prior year. Although our program assets are lower than last year, on a positive note, we're still seeing prepayment rates declining. Single family prepayments in the first 4 months of this year were approximately $126 million, which is about $53 million lower than the first 4 months of last year. On the expense side, bond interest expense is below budget by $5.7 million through April 30th and $5.8 million lower than prior year. The authority's outstanding bonds as of April 30th are $446 million lower than the same time last year, which accounts for a pretty large portion of the year-over-year variance. Administrative expenses are coming in $2.8 million under budget and $101,000 higher than prior year. When you exclude salaries and benefits, or $8.9 million, current year expenses are $522,000 lower than prior year's expenses. And lastly, the change in net position is above target by $7.1 million. Are there any questions?
There's no questions for Allison. We'll go to John Chilson.
Good morning. For the month of April, the authority purchased 97 loans totaling $20.4 million, of which 78 loans totaling $16.7 million were securitized, or 80% of our production. The remaining 19 loans totaling $3.7 million were whole loans. The average loan size was $210,000. The April month-end mortgage-backed security balance was $2.1 billion, which is a decrease of $9 million over the prior month, while the whole loan portfolio through March declined by 103 loans totaling $12.8 million, ending with a portfolio balance of $1.2 billion. The overall delinquency rate decreased by 14 basis points to 2.43%, and the carrying balance for loans in foreclosure year over year decreased by $6.5 million to $30 million, while the number of loans in foreclosure decreased by 33. For the month of April, the authority also funded 63 down payment assistance loans totaling $888,000 with an average loan size of $14,100. About 2/3 of CHFA's April borrowers took advantage of the down payment assistance program. With regard to single family forbearances, the outstanding as of March, there were 122 whole loans in forbearance involving $89,000 of monthly P&I payments on a balance of $14 million of UPB, or 1.1% of the whole loan portfolio. Of the 122 borrowers, 27% of those borrowers did make a payment in March, even though they had been granted a forbearance. With regard to our multifamily portfolio, there was one new loan closing in April. The portfolio remained the same count at 556 loans totaling $1.35 billion. The permanent loan delinquency increased by with a total of 8. There were no delinquencies in our construction loan portfolio, and there were no loans, no multifamily loans for forbearance. Our overall delinquency rate for the multifamily portfolio was 0.7%. Any questions?
Hi, it's Tim Hodges. I'm sorry, I'm driving, so I don't see the information, but you indicated that there's, in terms of foreclosure, can you just go over those numbers again?
Sure. So we look at the foreclosure year over year, and the number of loans in foreclosure from the prior year decreased by $6.5 million. So we have a currently outstanding UPB of $30 million in foreclosure, and that's 33 loans less than the prior year.
And so the 33 loans, tell me exactly what happened to those loans.
The numbers were really skewed through 2020 and 2021, because as loans rolled off of forbearance, because they had been forborne 3 months, 6 months, sometimes 9 months or more of monthly payments, when they came off of forbearance, they were checked that their loan status was, for the most part, if it was over 90 plus days, a foreclosure status, even though there wasn't actually a foreclosure being pursued. So that really inflated our 2020 and 2021 loans, both in serious delinquency as well as in foreclosure. And what we're seeing by this gradual decrease is the servicers working through the borrowers who had been on forbearance, for the most part, with various loan modifications to address the missed payments.
So these aren't, the 33 aren't foreclosures that have we've actually taken action on them. They're coming back into good standing.
That's correct. For the most part, there were very few foreclosures in 2020 and 2021, simply because there had been a foreclosure moratorium. The only exception to the foreclosure moratorium for vacant properties, and our number of loans that actually were foreclosed on were less than a handful in both 2020 and 2021. I mean, I think there were less. I think there were maybe 3 or 4 for 2021 at the most.
Great, thank you.
Any other questions for John? Okay, we'll go to the approval of the minutes of the April 28th Finance Committee meeting. May I have a motion?
Moved, it's Tim.
Second?
Second, Kathy.
Thank you. Roll call vote.
Gary Abrahams,
Aye.
Alexander Dahl, Philip DeFronzo,
Aye.
Timothy Hodges,
Aye.
Catherine McKinnon,
Aye.
Commissioner Perez, Franklin Perry.
I'm just going to abstain because I was not present at the meeting.
Sarah Sanders.
Aye.
The vote passes with 1 abstention.
Okay, and I'd just like to invite the board members. We have a couple new board members. If there's any topics you'd like to be covered in the future in the Finance Committee meeting, let us know. The one that I mentioned about trying to better understand all the impacts of rising interest rates on the authority. But if there's any areas that you have want more deep dive on, let us know and we can schedule them. Okay, any other matters? Have a great Memorial Day weekend, and I'll ask for a motion to adjourn. All in favor?
Aye.
Aye.
Thanks, everybody.
Thank you.
Thank you.
Minutes.
It's really, it was.